Welcome to Fireside Chat. My name is Sai. I want to talk about the 4 sources of passive income we're going to have during our early retirement. We're looking to retire early between the ages of 45 and 60, and during those 15 years, we need to have different sources of income to make sure our money never runs out before we reach our normal retirement age. Now, I'm not really a fan of the word passive because nothing in life is passive. I know we have to work hard now with our active income to build our passive income streams later on. Is passive income worth it? Absolutely. We're constantly adjusting our fat fire plan to retire comfortably without salaries or wages. The number one source of passive income we will have is dividend income, and this is the easiest way to build our passive income stream for early retirement. We have a taxable brokerage account that pays at least a 4% annual dividend yield, and we could also invest in an index ETF that tracks dividend stocks, but the yield doesn't reach the 3% threshold that we set for our portfolio. We are very cautious with what stocks we choose by doing our due diligence. The IRS defines dividend income as any distribution of an entity's property to its shareholders. I'm talking strictly in the form of the stock market securities, so these dividends are taxed twice. The first time is when the company pays a dividend to its shareholders, and then the second time is when shareholders report their dividend income earnings to the IRS. In a taxable brokerage account, whether I reinvest my dividends or get them paid out to my checking account, I have to report them to the IRS and get taxed as a qualified or non-qualified dividends. Make sure to read up on the dividend income rules on the IRS website. Non-qualified dividends are taxed under the federal income tax bracket, and if you own real estate and investment trusts or REITs, you'll pay income tax on the dividend distributions. If you work for a public company that pays you employee stock options, you will have to pay ordinary income tax. Before I purchase a dividend stock, I want to make sure it's a qualified dividend stock with a long track record of paying dividends to its shareholders. A company paying and increasing its shareholders for 25 consecutive years is called a dividend aristocrat, and a company paying and increasing its shareholders for 50 straight years is called a dividend king. Our target is to reach $1 million in our dividend stock portfolio parked in a taxable brokerage account and making $40,000 a year in dividend income during early retirement. Under the qualified dividend tax bracket, it's 0% in capital gains tax if our income is below $83,000, according to the 2022 IRS tax bracket. And we want to diversify our portfolio by having about 20 stocks with $50,000 each, paying about 4% in average annual dividend yield. And right now, we're still at about 6 stocks and reinvesting dividends right back into the stocks. Keep in mind that this is not financial advice, and this is a strategy that works for us based on our age, risk tolerance, and our knowledge of the stock market. Dividend stocks are known for being safe, reliable, and very, very boring investments. However, they still come with risks, so that we need to keep an eye on for the long-term outlook for every company we invest in. I pay attention to the company's balance sheets, forward PE, income statements, dividend payout ratio, company statements, and future revenue growth. I listen to their quarterly conference calls or the earnings calls to find out what the CEO and CFO have to say about their future revenues and profits. I pay attention to how management uses the dividend in their corporate strategy. Just because the dividend yields are high, like 7%, 10%, or even 15%, it doesn't mean the company is in a good shape. We have to pay attention to the company's dividend payout ratio and make sure they're not taking out debt to pay these dividends to their shareholders. If I see a business paying more than 80% of their earnings to the shareholders, that's usually a red flag to me, and because they're not making enough earnings to reinvest into their own business to grow into the future. And you should always do your own research before you invest in any stocks. When you invest in something you don't understand, now it's called gambling. And do what works for you and don't follow anyone else blindly, including me. By the way, you can download our free FIRE resources by visiting firesidechat.com/contact. And if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. The number 2 source of income we'll have is in real estate. And we want to eventually diversify our investment portfolio with real estate because it has a low correlation with stocks. However, it is not as liquid as stocks, so we would have to either sell or refinance to get the cash. Ideally, we would like to invest in duplex or triplex homes that can generate more cash flow. We're hoping to make more, about $20,000 a year in rental income during our early retirement. For example, let's say we find a duplex for $400,000, we make a 20% down payment of $80,000 and another $50,000 to renovate, then our initial investment is $130,000. Keep in mind that I'm using the most generic numbers here, and our mortgage loan for $320,000 with a 4.5% 30-year fixed interest rate should be around $1,600 a month, but that's not counting the HOA, homeowners insurance, maintenance, property management, and taxes. Let's assume my monthly expenses are about $3,500 a month to keep the duplex, and the rent per unit is $2,200 a month. Then our monthly cash flow would be around $870 a month, or 8% cash ROI. That's $10,440 a year in cash flow. So if I divide it by our initial investment of $130,000, it's around 8% in cash and cash return. Going into our early retirement, the only debt we should have is our rental properties. And we want to start with one rental property during the first year to get our experience in real estate. And I learned more from actually investing in the stock market than actually doing the research. Not that I'm saying I won't do any research in the housing market, but our goal is to have our rental properties ultimately paid off before turning 60 to reduce our risks significantly. And we want to make sure we're leveraging our money into properties that will increase in value over the years. The downside of buying rental properties is that we need a lot of cash up front for repairs and down payment. It can be extremely time consuming during the first year with maintenance, repairs, and maybe even with tenants. We also want to be very careful with debt to buy properties because they can work either in our favor or against it. And I'll be sure to make a video about it when we purchase our first rental property. And let me know in the comment section down below what your experience has been so far with your rental properties. The number 3 income source is the capital gains in our taxable brokerage account, and we're going to maintain 4% or less in the withdrawal rate during our early retirement. Our target for the taxable brokerage account is around $1.5 million, and the withdrawal rate for this account would also depend on other income like the dividend stock portfolio and real estate. For example, 4% of $1.5 million is $60,000 a year. If we already have $40,000 a year in dividend income and another $20,000 a year in real estate, that's a total of $120,000. Then we would probably reduce our income from this portfolio to $40,000, or a 2.5% withdrawal rate. You might be asking why we will want to lower our withdrawal rate. That's because we want to grow our portfolio for as long as possible. So we don't want to make any unnecessary withdrawals that might increase our tax rate or slow the growth in this portfolio. We also probably will need any more than $100,000 a year during our early retirement. Our expenses right now are at about $50,000 a year, and that's with our mortgage payments. The long-term capital gains tax rates for the 2022 tax year are 0% for income under $83,350, and income between $83,000 and $517,000 would be at 15% tax rate. So, for example, let's say I have $1 million in Vanguard Total Stock Market Index Fund, and I withdraw $40,000 during the year 2022. If our adjusted gross income with the $40,000 capital gains is under $83,350, then the tax rate will be 0%. If it's over $83,351, then it's 15% of the $40,000, which is $6,000. I'm not a CPA, so make sure you talk to a tax advisor if you're curious about your tax rates during your early retirement. The number 4 income source we'll have is the health savings account, and as of right now, we should have about $150,000 by the time we turn 45. We could keep this cash set aside and not touch it until we turn 55 or 60. If we don't withdraw from this account with a 10% average annual return, we could have $255,000 by the time we turn 50, or $459,000 by the time we turn 55. That's also assuming that we continue to contribute to our HSA if we identify ourselves as self-employed with the IRS. After we quit our 9-to-5 jobs, and if I continue to work on my YouTube videos during our early retirement, we could contribute to the HSA on a family plan as a self-employed individual. Because the HSA has a triple tax advantage, we could lower our taxable income by contributing to our HSA. So for example, if we contribute $7,300 to our HSA family plan and our income is $100,000 in retirement, then we could lower our taxable income to $92,700. We could also invest in index funds like the S&P 500 inside our HSA, and it can grow tax-free. You can check out the detailed video I did on the HSA, and I will link that video in the description below. The only downside of the HSA is that we need to be extremely organized with our receipts from pharmacies and clinics, and what we pay today to our pharmacy will get reimbursed later on in our early retirement. And let me give you an example. Let's say I made a copay for my prescription medication in the amount of $100 today in the year 2022, and I'm going to use my own cash and keep that receipt for my record. Fast forward to the year 2032 when I'm in my early retirement and say I want to withdraw $100 to buy a birthday gift. I can submit that receipt to my HSA and get reimbursed. And there's no time limit or timeline on when you have to file a reimbursement for any medical and dental expenses. However, if we just withdraw from my HSA without providing a receipt and I use $100 for a non-medical expense, then I will have to pay the IRS 20% penalty and federal income tax. And that could be a 40% in penalty out of that $100 I withdrew from my HSA for not using it for a medical expense. After I turn age 65, the 20% early withdrawal penalty goes away, and the only thing we will have to pay is the federal income tax for the HSA withdrawals. And imagine having over $1.2 million in our HSA when we turn 65. That would be awesome, right? The number 5 source of income is my military pension and the federal employee retirement system, but I don't think I'll have time to talk about them in this video. Let me know in the comment section below if you enjoyed this video and want to know more about the military pension plan and federal employee retirement system. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.